Your bank is not a building. It is not a logo. It is not a customer service representative who smiles when you walk in. Your bank is a behavioral system, and it has been studying you longer than any therapist, longer than any partner, longer than anyone who claims to know you well. It knows when you feel anxious. It knows when you feel hopeful. It knows when you are 3 days away from payday and your resolve is starting to crack. Most people believe banks are neutral, a place to store money, a service you choose, an institution you can leave whenever you want. They are not neutral. They are designed, and the design is built around one thing: understanding exactly where you are weak before you do. You have probably seen someone like this. Maybe it is someone you know. Maybe it is you. They wake up and check their phone. Not their messages, not the news, their bank account. First thing, before coffee, before anything. The number is fine, but fine does not feel fine because 3 days ago it was higher, and next week a direct debit is coming, and there's a dinner on Saturday they said yes to without thinking. So they close the app, and the low-grade anxiety settles somewhere in the back of the chest where it lives most of the time. By midday, they get an email, a pre-approved offer, a credit limit increase, 0% for the first 12 months. They almost delete it, but they do not delete it. They think, just in case. They don't spend the money, not yet, but they accept the offer because declining it felt like closing a door they might need later. That evening, they come home tired. They open a streaming app and a food delivery app, and a subscription they forgot was active takes a small amount from the account. Not enough to cancel, too small to feel, too consistent to notice. This is a normal Tuesday. This is the average financial life of an average person in a developed economy, and every single moment in that day, the anxiety, the pre-approved email, the forgotten subscription, the dinner they couldn't say no to, was predictable. Not just predictable in hindsight, predictable in advance, because the system was not reacting to this person. The system was built for this person. Here is what most people believe about banks. They believe banks want them to be financially responsible, to save consistently, to pay on time, to build good habits. Banks send newsletters about budgeting. Banks run financial literacy campaigns. Banks tell you to plan for the future. And people believe this because it sounds reasonable. Why would a bank not want healthy customers? Here's why. A customer who saves consistently and pays cash for most things and carries no ongoing balance is nearly useless to a bank. They cost money to serve, they generate almost no fee revenue, they pay off their credit card in full every month, they don't need overdraft protection, they don't renew short-term loans. They are, by the logic of modern banking, a problem to be managed, not a customer to be cultivated. The valuable customer is different. The valuable customer has a balance they maintain. Not so high it becomes unmanageable, not so low they default. Right in the middle. Stable, reliable, recurring. They pay the minimum each month. They carry a revolving balance. They occasionally need a little more. And when the bank sends a pre-approved offer, they accept because the system learned months ago that they would. This is not speculation. This is the foundation of behavioral scoring. Banks don't just look at your credit history, they look at your patterns, how often you check your balance, what time of day you log into your banking app, whether you move money the day before a bill is due or the day after, whether your spending increases after a stressful week, whether you are more likely to borrow in November than in March. These patterns are not random, they are signatures, and the bank reads them, not to help you, to time you. An offer sent on the right day is 3 times more likely to be accepted than the same offer sent on the wrong day. You didn't decide in a vacuum. You decided exactly when the system expected you to.
The second reversal is this. Most people believe that financial stress is caused by a lack of money. Sometimes it is, but often financial stress is sustained by the structure of the products themselves. Minimum payments are not a kindness, they are a mechanism. When the minimum payment is $90, you pay $90 and feel responsible. You do not think about the fact that $90 barely touches the principal. You do not think about the fact that at this rate, a $4,000 balance takes 11 years to clear. You feel like you are managing. The system needs you to feel like you are managing, because the moment you feel like you are behind, truly behind, you might do something unpredictable. You might stop paying, you might consolidate, you might actually read the terms. So the minimum payment is calibrated to keep you functional, not free, not ahead, functional. The third reversal is this. People believe financial anxiety is personal, a sign of poor discipline, a symptom of bad decisions, something to be ashamed of. It is not personal. Financial anxiety is a business output. When you feel a low-level panic every time your balance dips, you are more likely to keep a buffer. When you keep a buffer, the bank holds more of your money. When you feel uncertain about your credit, you are less likely to shop around for better rates. When you feel lucky to be approved, you accept the terms without negotiating. Fear is not a side effect. Fear is infrastructure. To understand this, you need to understand one thing about how modern banking works. Banks do not make money from your deposits directly. They make money from the spread, the difference between what they pay you for your deposits and what they charge others to borrow them. But the most consistent revenue does not come from institutional lending. It comes from behavioral fees, overdraft charges, late payment fees, interchange fees every time you tap a card, interest on revolving balances, foreign transaction fees, annual fees on cards that offer rewards you rarely use. Each of these individually seems small, $35 here, a few percentage points there, but collectively, across hundreds of millions of customers, across 12 months, they are enormous. And they are not random, they cluster. They cluster around the moments when people are distracted, tired, behind, or hopeful. The overdraft charge happens when you are already stretched. The late payment fee happens after a difficult month. The foreign transaction fee happens on the 1 week a year you are relaxed and not watching the details. These are not oversights the bank is waiting for you to fix. They are design features. The credit scoring system works the same way. A high credit score does not mean you are wealthy. It means you are consistent. It means you borrow regularly and repay regularly and borrow again. The perfect credit score is not the score of someone who does not need credit. It is the score of someone who has demonstrated they will use credit forever. The system does not reward freedom from debt. It rewards predictable engagement with debt. This is not malicious in a simple sense. It is not a room of executives laughing. It is structural. Banks are optimized over decades to identify and retain the most behaviorally reliable customers, and behavioral reliability looks almost identical to financial anxiety. Worried people check their accounts more. Worried people pay on time to avoid fees. Worried people accept offers because declining feels risky. Worried people stay. Once you understand this, you start to look at ordinary financial moments differently. The welcome bonus on a new credit card, generous, obvious, immediate. The points or cash back feels like the bank giving you something. It's not. It's an acquisition cost. The bank calculated that the behavioral value of a new enrolled customer, the interest, the fees, the inertia, the years they will stay, outweighs whatever it costs to get them in the door.
The bonus is not a gift. It is the opening bid in a long negotiation where only one side has done the math. The pre-approved offer. The language is designed carefully. Pre-approved, not applied for, not considered, pre-approved. It is framed as recognition, an acknowledgement of your standing, an exclusive access you earned. What it actually means is that the system identified a behavioral window, a moment of likely acceptance, and it sent the offer not because you deserve it, but because you are likely to take it. The savings account interest rate. The bank pays you, say, 0.4% on your savings. It lends that same money at 7 or 12 or 22%. And the difference is not hidden, it is in the terms, it is publicly available. But most people do not compare these numbers because they don't think to, because they were not taught to, because the system benefits from that particular gap in attention. The subscription that auto-renews. Not from your bank directly, but banks are deeply embedded in the infrastructure of subscription billing. Every card on file renewal, every auto charge passes through systems that your bank is part of. The friction to cancel is not accidental. Friction is designed because the default state, the state you stay in unless you take active steps to leave, is the profitable state. And this is perhaps the deepest thing to understand. Default states are not neutral. Every default in a financial product was chosen by someone who thought carefully about what happens when people do not act. The default payment is the minimum. The default renewal is yes. The default overdraft protection is enrolled. The default investment option is conservative, which means low growth, which means more years of the bank holding your money. Defaults are policy decisions dressed up as convenience, and once you see them as decisions, as choices made by someone else for someone else's reasons, you can start to ask, what would I choose if I were choosing for myself? There is no dramatic ending to this, no list of 10 things to do tomorrow, no promise that awareness leads automatically to freedom. It does not work that way. The system is old and well-resourced and built by people who have studied human behavior for longer than most people have thought about money. But there is something that changes when you understand how this works. Not anger, not paranoia, something quieter, a slight separation between the impulse and the action. The pre-approved email arrives, and for a moment, instead of feeling chosen, you notice that you feel chosen. You notice the warmth, the small lift, the sense that someone decided you were worth something. And you can ask, where is that feeling coming from? The answer is from a system that learned how to produce it. That separation, that one moment of noticing, is not nothing. It does not require discipline. It does not require a new budget app or a financial advisor or a different relationship with money that you have to build from scratch. It just requires recognizing that the emotion you feel when you make a financial decision is part of the product design. The anxiety that makes you keep a buffer, product design. The satisfaction of a rewards point, product design. The guilt of carrying a balance which keeps you paying just enough to stay current, product design. The hope that a new card, a new loan, a new offer will finally get you ahead, product design. These are not your failures, they are inputs into a system that runs on the assumption that most people will never look at it clearly. The most dangerous customer from the bank's perspective is not the one who defaults. Default is accounted for, priced in. The most dangerous customer is the one who becomes indifferent. Not hostile, not paranoid, indifferent. The one who no longer needs the approval of a pre-approved offer to feel financially valid. The one who checks their account and feels nothing except information. The one who looks at the minimum payment and does arithmetic. That customer is hard to time, hard to reach, hard to move because the lever the system uses, emotional vulnerability expressed as financial behavior, no longer connects. You do not have to leave the system. You probably can't, not entirely, but you can operate inside it with a different quality of attention, and that is enough to change what it can take from you.